every part of the stack is going to have to create more value than they charge. That's just obvious. And if that doesn't happen, it will be a bubble.
Hello, everyone, and welcome to the week ahead on Nomura Podcast. My name is Dominic Bunning, head of G10 FX strategy here at Nomura, and today is Friday, the 7th of November. Well, it's been quite the week in financial markets, especially in equity land. We heard just there from Alex Karp, the CEO of Palantir. Even he made the point that if value creation in the AI and tech space can't be maintained, then there certainly is the risk of a bubble. Stocks have seen a bit of a wobble, although the fall from the peak in the Nasdaq of currently less than 5% as we record doesn't appear to be accelerating for the time being. On this front, I'm really excited to be joined this week by Nomura's cross-asset strategist, Charlie McElligott, who is not a member of the global research team, it must be said, but is a true expert on this space and something of a financial market podcast veteran. He's going to guide us through what is driving these moves in equities and what to watch in terms of bubble risk. Outside of stocks, politics is still front and center in the US regarding both the ongoing shutdown, where only minor progress appears to be being made, and on tariffs, with the Supreme Court looking at Trump's IEEPA tariffs. We will discuss this, the latest US data, and the Canadian budget with Rishi Sharma from our US economics team. In Europe, the Bank of England decision had markets on the edge of their seats in an incredibly close vote, albeit for unchanged rates. Josie Anderson will explain how we're viewing the next steps in the UK and look briefly at Scandinavian economic divergence. Finally, our Asian economic team have published a deep dive on how the region's trade deals with the US are evolving, which we'll discuss in detail with Sonal Varma. As always, it's a lot to get through, so let's get stuck in. We're going to start this week with a very, very special guest. I'm joined by Charlie McElligott, who is Nomura's MD of Cross-Asset Strategy based in New York. Charlie's very well known far and wide across financial markets for his views, his color analysis, particularly in the world of equity and equity derivatives. So we thought he would be the perfect guy to talk us through the latest developments over in the US. I will add before we start, Charlie is not a member of the global research team, sitting instead on the markets desk, and his views are not direct investment advice. So with all the small print covered, Charlie, thank you very much for joining us.
Great to be here, Dom.
So look, US equity is clearly having a little bit of a wobble at the moment. In a relatively short space of time, and as you know, as high level as we can be with these things, what do you think is really going on at this point?
I think there's a number of dynamics at play here. I mean, I'm always remiss when, dealing with, client inquiries or oftentimes stuff from, media where, they try to, bring this concept of, standalone valuations as the problem in and of itself. Like valuation in and of itself is never going to be a basis for a short or a pullback. I would say, however, there is something to this idea and the nature of the rally and the speed of the rally and the ferocity of the rally, and certainly of late, the concentration of the rally, that has created more discomfort. So often when you are seeing kind of like a topping process in the markets, it's not necessarily, the negative catalyst that makes things go wrong. So say in this case, with regards to the impact and the importance of the AI trade and the Mag 7 type names, that has created this dynamic where this incredibly small concentrated group of stocks is almost single-handedly supporting and driving the market, while almost everything else is significantly lagging. So you have this massive performance dispersion, like top decile, bottom decile dispersion, which is like a 90th percentile in a multi-year look back. So you have this concentration dynamic that makes people increasingly uncomfortable. And in this case, that concentration is being driven by this big theme, this exciting theme, this theme that has, captivated investors, particularly retail. But what it's led to, as this concentration keeps growing and these names keep doing more of the heavy lifting and they're generating more of the earnings growth, obviously the CapEx bubble is its own story. There's a circular funding logic to it. All of these things create, additional discomfort, and they create this pro-cyclicality. I would even add the fact that, market structure stuff, the things that I love to talk about, right? Like options or leveraged ETFs in this case, where assets under management are, you know, exploded basically to 160 billion bucks, 100 percentile all time high. 84% of those assets in the leveraged ETF space are kind of that same zeitgeist, animal spirits, Mag 7, Mag 8, AI, tech, mega cap tech leadership. So there's this amplification, this shadow leverage, real and synthetic, that has made this trade like the singular input to the direction of equities. And back to that point, it's not always the negative catalyst. It's not necessarily this idea that, margins start going lower in one of these story stocks. Sometimes it's the stock stopped going higher on good news. And we've gotten a little bit of that just recently off the back of, the meat of the earnings in these core names, these hyperscalers last week where, unbelievable earnings prints, unbelievable earnings growth and profitability, all of the good things that you want to see that has, created this hysteria in these names, but they're chopping. And, I do think that some of this is a little bit of a function of a regular market phenomenon that we tend to see in September and October, where, almost 1/3 of mutual fund assets under management, you see a year end in that period. And what you then tend to see from a factor perspective is this really, expansive move where winners mark up and losers, particularly like tax loss selling candidates, get marked down. And we saw this huge blowout in that type of dynamic in the last few weeks, where I think people have this fear of the right tail. You can't own enough of these story stocks. You had this regular seasonal phenomenon of mutual funds and, marking up, retail chasing into out of the money calls. And it really just created this kind of like perfect storm where you almost ran out of juice. And now you've started to kind of, reverse out some of these dynamics as you've transitioned now out of that period. And you tend to get kind of this dynamic where the losers reset a little bit lower and some of the cheap stuff, that's been left behind for a reason starts to, begin to outperform. And you've seen that a little bit too with, people's short books going haywire on the equity side. Where it's really low quality, high vol stuff, but it's been, exploding higher. So I think there's a market phenomenon. I think there is, with regards to the flow, but I also too think that, the expectations have to get reset at some point with how important these are with regards to, the water that raises all boats in equities.
Yeah, there's a lot to unpack there, Charlie. I mean, like you said, it's a very complex topic, this sort of thing. And we obviously are very guilty in our world, particularly of trying to boil things down to one or two key points. But I do just want to pull up one word you said there, because you did mention the word bubble, which I know is getting thrown around a lot, but you mentioned it in the context of CapEx. Just talk me through a little bit. How are you thinking about, is this a bubble? Should we care if it's a bubble? Just in terms of that word being used in a narrative sense, it's clearly there. But from a more sort of almost specific perspective, what would make you worried that this bubble is going to pop? Do you think it's something that can sort of keep going? How do you kind of think about that term and how you use it more generally?
So, I mean, that's an awesome question. Qualitatively, when looking back at prior bubbles, I think, one slightly more tangible concept is just this idea of like malinvestment. And I don't want to call what is happening right now malinvestment, right? The huge difference between this and say like, the tech bubble, pets.com and that type of stuff was that those were, money losing companies and concepts and business models that had never been proven out. This is a completely different dynamic. It's, huge profitability already being, generated from, companies that are, then have been funding this with organic cash flow. The thing that gets interesting for me, particularly as we start talking about next year, is the velocity by which this CapEx spending Cold War effectively is growing. And the two key points as it relates to that, for me, with regards to flows that have been structurally at the core two dynamics that have been, as macro factor inputs structurally at the core of what's happened over the past, 15, 20 years almost since the great financial crisis, um, that could, in super rare circumstances, actually see a reversal of these, what have been, phenomenal tailwinds for equities are, and there's an interplay here. There's a structural downside risk for AI stock leadership, and accordingly, all of these equities next year, if the demand for AI capex overwhelms and burns through the current organic cash flow generation. And the double whammy here that I don't think, that I think people are just starting to talk about now. It's starting to, so this is something I've been talking about the last couple of months. And I think it's now gaining wider acceptance and being more widely socialized, is that first, as companies are now expanding capex through new debt issuance, right? You've seen over the last couple of weeks these big investment grade offerings, and people were trying to get up in a tizzy with regard to credit a few weeks ago, but on the super subprime, esoteric, small size idiosyncratics of First Brands and Tricolor and some like consumer lending stuff with, increasing delinquencies and stories of that nature, where people are worried about one cockroach, and is there this kind of '07, '08, scenario here? To me, the credit spread widening and the kind of the bearishness with regards to credit right now is not about a systemic risk of that stuff going wrong. And banks no longer are the ones that have that stuff levered 30, 50 times in their balance sheets. It's private credit. It's BDCs. It's these companies that, they're going to be the shock absorbers. That's great. Like, that actually works. Credit is going to go wider, I think, right now, or the unattractiveness of credit with spreads where they are at tights, multi-year tights, is because of this looming supply from mega cap tech. These are the biggest bond offerings in the market right now. The demand for AI growth is outstripping the organic cash flow, and they got to hit the debt markets. So you've had these huge deals in recent weeks, Oracle and Alphabet just, this week. And I think when that amount of supply is coming in a sector that is ballooned to be, a massive part of the investment grade space, the supply demand simply with credit spreads at tights makes this really unattractive. So, that's the first part. It's the supply demand risk reward. It's not a subprime contagion systemic issue, but the other then, and this is maybe the biggest one of them all, is the impact that this, capex, impulse, capex bubble, if we want to say, is going to have potentially on corporate share repurchases, on buybacks. For the past, 15 years, the single largest source of demand for equities in the United States has been corporate buybacks. And it's been a winning trade. And it's effectively, in the world that I sit in, it's effectively the biggest short vol trade there is. It suppresses movement in the sense that it shrinks the float of equities, right? So it's shrinking the supply of equities, is this passive source of demand under the market. This year alone, right? Announced buybacks are now upwards of $1.2 trillion. It dwarfs, I'm measuring, supply demand imbalances with day-to-day flows in the option space or leveraged ETFs or CTAs or vol control in the, billions. And we're talking about 1.2 trillion of announced just kind of like right now, this moment in time. So, the trick here over the past 15 years, they don't just act as a short vol supply because there's this passive bid and they shrink the flow. But, when the market pulls back, they are most active. So it is a synthetic source of like long gamma. And for like the non-options folks out there, that just means it's a counter-cyclical flow. Whereas the market is selling off, you have this absolutely massive bid under the market that acts as an insulation device, as a stabilizer. And in that case, it's just, you can't overstate the impact of the buyback impulse. So, when you are talking about buybacks are a synthetic short vol flow, a synthetic long gamma flow that acts as a shock absorber, because they get more aggressive into pullbacks. If you begin to see an inflection lower in something that by and large has just gone higher every year with regards to, say the S&P 500 announced buybacks, which by the way, the 90-10 split of that is the biggest 20 companies, let's say, which are the Mag 7, Mag 8 Halo companies that if that cash flow has to now begin, being kind of outstripped into these AI pursuits, into the data centers and into the energy requirements and all that good stuff that comes with this phenomenon, you have a real double whammy here of wider credit spreads next year and potentially from a flow versus a stock perspective, an inflection lower in the buyback demand. And that is something that we haven't dealt with in 15 years. And people don't understand in the background, how critical those flows are. So it's a pretty interesting concept that ties back into this idea of like just simply the bubble outstripping, this kind of initial source of funds. And it could be a really interesting dynamic as I think we look into 2026 because it's starting to happen now. You are seeing credit spreads widen a little bit. And you are seeing these companies no longer get rewarded right now because it kind of seems like we've moved through this first phase where, perpetual headlines on, CapEx spend have not been, rewarded by the market. It's going to be a more nuanced story going forward. And I think people are going to want to see more tangible kind of linkage to, returns and profitability.
Brilliant, Charlie. I mean, I could literally listen to you talk about this all day long, as I'm sure the guys on listening could do as well. But we're going to have to cut it off there and say thank you very much. But I mean, just for me, the key takeaways, and I think it's really interesting. You mentioned keep an eye on credit spreads, keep an eye on share buybacks in particular, these kind of dynamics. Maybe not the first thing people focus on. People maybe just want to look at the earnings or they want to look at the price itself. But actually looking at some of those things going on under the radar could be pretty crucial. So thank you so much for sharing that. And hopefully we'll catch up with you soon. Thanks a lot.
Cheers.
Well, we're going to stay in the US. We're going to be joined by Ruchir Sharma, our US economist. Ruchir is going to keep us up to date on the latest economic and political developments. Ruchir, it does seem that there are two lingering political themes hanging over the US. One's obviously the shutdown. So the first question, which we ask you guys every week, is how long can it drag on for? And then the second is more to do with the Supreme Court and the hearing around Trump's tariffs. What are the early signs on that as well, and how do you see that playing out?
Hey, so far the shutdown now, it's officially the longest in the US history, but we've seen some positive signs. So what we saw was earlier this week, Senate Majority Leader Thune said that there's some progress and the Senate is getting closer to an off-ramp to end the shutdown. And as we've seen that President Trump has persistently called out the Republican senators to end the filibuster, but we think that it hasn't garnered enough support. So for the silver lining, it seems like the negotiations, they're actually progressing forth, and the agreement seems to be shaping up around a minibus with the continuing resolution and probably setting a vote on the Affordable Care Act subsidies. So the thing in contention is about the timeline or the length of the continuing resolution. It seems like the White House and Speaker Johnson, they're probably aiming for January, but the Senate Republicans, they're probably looking at for December. But regardless of the timeline of the continuing resolution, we think that a resolution is in sight, and there's been some positive development. So we could see something probably early next week. As for the Supreme Court hearing on the IEEPA tariffs, based on the hearing, we think that it's likely that the Supreme Court strikes down the IEEPA tariffs. Specifically, Chief Justice Roberts, Justice Gorsuch, and Justice Barrett, they might join the other three liberal justices to reject the tariffs, and we might see a ruling as soon as the end of this year. So that said, we think that tariffs are far from over yet, and White House, they do have other legal options and authorities like Section 122 and 338, 301 to impose tariffs. So one of the things, and it's a plausible scenario, is that the Supreme Court gives the White House a grace period to recreate these tariffs before revoking the IEEPA tariffs. And it's their opinion that Justice Roberts has historically been concerned about the practical ramifications of the Supreme Court's judgment. So that's another case.
Interesting. Thanks, Rishi. I mean, there's a few things in there that can certainly move markets and possibly provide a bit of support from a risk appetite perspective. I think if you do get a bit of relief on tariffs, or if you get the end of this shutdown, which is obviously causing some challenges. I do think one thing on the shutdown, we're obviously not getting much US data. We're getting a few bits and pieces. We're getting some surveys. We're getting ADP employment numbers, jobless claims, a few other bits. How are you guys seeing the economy evolving as the shutdown kind of persists? Are things getting any sort of worse, or is it just more of a case of slow and steady in the US economy at the moment?
Yeah, so actually the data that we got this week that actually points to some sort of a stabilization. So we've been, as you said, we've been closely monitoring if labor markets specifically, are they cooling gradually or are they falling off a cliff? And the data that we got again pointed to some sort of a stabilization and a very mild cool down. So talking about ADP, we saw that the private employment gains, they actually rebounded following 2 months of decline. So that was a positive. And additionally, we got some survey data. The ISM Services Employment Index, it improved modestly. Though it remained below 50, that's the expansionary contractionary threshold, firms continue to report that the labor market weakness is more due to attrition and not due to layoffs. So that's why we were somewhat less concerned about it. And finally, we also got the challenges data, but we think that it should be taken with a salt of grain because it has sent some false positives in the past. And another reason to be skeptical of that data is because Challenger takes into account the announced layoffs and not the actual layoffs. So in the past, we have seen that other data like jobless claims, it hasn't moved very closely with the Challengers data. So that's why we are a bit skeptical about the spike that it registered in October.
Okay, so still sort of more of the same, and until we see a more clear picture where layoffs are picking up, there's not too much to be concerned about, I guess. Moving north of the border, in Canada, we had the budget announced earlier in the week. What was your take on what Mark Carney was able to deliver over in Canada?
Yeah, so the finance minister in Canada actually did loosen the purse strings. So Prime Minister Carney had been repeatedly mentioning that the theme of the budget would be investment and austerity. But my take is that the budget prioritized investment over austerity. And it was primarily aimed to address structural issues that have beset Canada for long. So many of the policies that we saw in the budget, they were actually known prior to the budget, and the net new stimulus information that was somewhat limited. So as was widely expected, the operating budget and the capital budget was separated for the first time. We think that the fiscal situation in Canada isn't alarming per se, but it does require some constant vigilance. And finally, I think most of the policies that were introduced in the budget, they're more of a long-term kind of a growth. They're more important in long-term growth kind of a perspective. And the budget fell slightly short of providing an imminent relief. So this is going to be somewhat tough for the BOC and could increase the likelihood that they'd have to cut further and resume cuts to spur growth in the near term.
Interesting. Thanks very much, Rishi. I mean, it's the first fiscal focus is picking up all around G10, and Canada often isn't really mentioned in line with some of the other places with big fiscal concerns. But it's always interesting to me to see that actually, when you look at debt to GDP, it's not at the low end of the spectrum. So we'll see if the market lets Canada get away with that fiscal stimulus. Certainly worth watching in the weeks ahead. Thanks for coming on as always, and we'll speak to you soon.
Thanks for having me.
Well, it's been a pretty exciting week in Europe as well, with 3 central bank decisions, and the Bank of England especially garnering a lot of attention. Josie Anderson from our European economics team is here to give us the lowdown. Josie, thanks for joining us. The Bank of England left rates unchanged on Thursday. Now, that was kind of pretty much in line with consensus, although we had been looking for a cut, albeit it was a very close call. It does still look like there's further cuts to come. Can you talk us through the decision and what your thoughts are from here in terms of further easing?
Yeah, thanks, Dom, and thanks for having me back on the podcast. So it was certainly exciting in the UK in terms of monetary policy this week. As you said, we expected a cut, but knew that would be very tight. And indeed, it was a tight decision. So the 4 more hawkish members of the MPC, the 9-member MPC, did indeed vote for a hold, as we expected them to. And the 2 far more dovish members voted for a cut. And so that left 3 swing voters. And of course, we know, as you said, that they did indeed leave rates on hold. So an extra fifth member, in fact, the governor voted for a hold, and two of those swing voters voted for a cut. So that left the governor with the deciding vote, essentially. So we think it was very close. We got new communications even from the Bank of England, so we could even read what individual members thought about the decision. And we heard from Governor Bailey talking of further policy easing to come if disinflation becomes more clearly established. So that suggests that the MPC is open to more cuts. And we have been saying for a while that if they weren't to cut this week, then we think a December cut is likely. And talking about why it was a close call in the UK, well, for a while, MPC members have been saying that the disinflation process is happening too slowly. But then when we've been looking at the data that's been released over the last few weeks, we had inflation surprise on the downside, and we had labour market data looking a little more soft, in particular with slow wage growth. So that meant that indeed this week we did think there would be a cut, and there wasn't. But now we think, looking at more data ahead of the December decision, we think that they will be able to analyse that data and vote for a cut in December, followed by, we think, a final cut now in April.
Okay, interesting. Now, you mentioned the data there. We do actually get some labour market data next week, and we get the quarterly GDP report as well. What sort of data are you looking for in the week ahead, and would it be consistent, or what would be consistent with a December cut in your view?
Yeah, thanks. So on the labour market, well, as I said, there were very, very soft private sector regular pay growth in the last labour market report. So it wouldn't be a shock if we get slightly some payback from that. But we're forecasting 0.3% month-on-month growth in that measure. We are forecasting a slight rise in the unemployment rate. The latest month of data, you can look at the single month data, came in with quite a high unemployment rate. So we could see for the whole of Q3, the unemployment rate rise again to 4.9%. We actually had new unemployment rate forecasts from the Bank of England, and they raised their peak unemployment rate forecast to 5.1% by Q2 next year. So they do think the labour market is softening, as do we. On the GDP growth front, it's been quite strong in the first half of this year. So we had 0.7 followed by 0.3% quarter-on-quarter GDP growth for the first two quarters of the year. We're forecasting that to slow to 0.2%. So all in all, it paints a picture of a slowing economy in terms of a slightly softer labour market and slower GDP growth.
Okay, cool. Thanks very much, Josie. Away from the UK, we did actually get two other central bank decisions, Riksbank and Norges Bank, both left rates unchanged, but there does seem to be still a bit of scope for divergence. What's your latest view on the Scandis?
Yeah, thanks. So, yeah, we expected them both to be unchanged, and indeed they were. But yeah, they're quite different situations, really. So in Sweden, the Riksbank's now cut several times to a rate of 1.75%. But the economy has still seen above target inflation. But the reason why they have cut, and indeed they did the last cut, was because economic activity growth has been looking pretty weak. But there are signs it's starting to pick back up. And also the government announced quite an expansionary budget for next year. So we expect that there'll be no further cuts there. Indeed, potentially the next move could even be a hike, but we're talking a while in terms of that, perhaps late 2027. Meanwhile, in Norway, they're still in the early stages of their cutting cycle. So they've cut twice this year in 2025, but inflation's still looking a bit sticky in Norway. In fact, the last print was 3.6% for headline CPI, so well above the 2% target. And so they are being quite cautious in terms of rate cuts. And the latest guidance was that they will cut once per year for the next 3 years. Now, we think there's evidence that some slight softening in the labour market, and we have a slightly faster pace of disinflation in our forecast, and Norges Bank will mean that they can cut slightly faster than they're currently projecting at a semi-annual pace for the next 3 cuts.
Great, thanks, Josie. So, yeah, a fair bit going on there, and a few things certainly to watch, not just in the weekend, but also in the months ahead up in Scandinavia. Thanks once again, and we'll speak to you soon.
Thanks, Tom.
Now, moving on to Asia, where we're joined by Sonal Varma, our chief economist for Asia Ex Japan. Sonal, thanks for coming on. You've just released your latest Asia Economic Monthly, and I think you're looking specifically at some of the trade deals that have been done between the US and various Asian economies. What's the latest take from you guys on where things stand there?
Yeah, Dom, hi. So trade deals, trade frameworks, and investment deals. So there's lots that's actually happened in the last month. I mean, from Asia's perspective, our view is these have actually been lopsided deals because Asia has actually, given large commitments to invest in US, buy more US products. Many countries have actually lowered tariffs on US imports, whereas the reciprocal tariffs from US on most of the Asian countries have not moved much. So, but I think broadly speaking, the deals we think have important near-term and medium-term implications. So from the near term, it reduces the trade policy uncertainty, which is a positive for Asia incrementally. The 10 percentage points lowering of China's tariff rate actually narrows China's tariff gap with rest of Asia. So that will shift, in our view, some of the trade flow patterns during this truce period. So, for instance, the transshipment that was happening via Southeast Asia should taper down as China's exports to the US directly start to pick up. I think there are more important medium-term implications. So I think one question has been, how does all of this shift the supply chain moves in Asia? And our view is that despite the US-China truce, the supply chain shifts, or the China plus one strategy, as we call it, will continue because there's obviously a lot of uncertainty on how long the US-China truce continues. So MNCs are likely to shift supply chains mainly because they want to mitigate risk. It's not tariff driven. I think the interesting change we've seen in the US deals is that US has tried to tie up on the various critical mineral supply chain partnerships in Asia to gradually reduce its reliance on China. Some of the provisions in the trade agreement actually, in our view, signal the US's intent to bring countries under its economic sphere of influence. So US is using trade as a leverage there. Two other things that stood out to us, I think, one silver lining in our view is that Asian economies are finally being forced to reform and open up their markets to more competition. So they are easing their non-tariff barriers for the US, which in a sense is reform by stealth and should be positive for these countries. And finally, one observation is that while countries are doing deals with the US, they're also simultaneously pursuing multiple free trade agreements, and these negotiations are going on across different regions. So a lot of countries in Asia are trying to actually hedge their bets.
Thanks, Sonal. That's pretty interesting. Seems like there's a few potential positives out there on the horizon from some of these deals. Have you guys made any major forecast changes on the back of this?
Well, we have on the back of this, plus some of the incremental data we've got. So I think two main themes that come out. One is the growth resilience from the second quarter has extended into the third quarter. So exports are holding up and tech demand is still quite strong. So we've gotten upside surprises on third quarter GDP, and we've therefore revised up our growth projections for the likes of Malaysia and Singapore. I think the exception here is Philippines, where weak government spending was confirmed in the disappointing third quarter GDP estimate this week, and something we think will sustain for now. The second big theme I think that's emerging across Asia is that Asian central banks are turning more cautious in terms of cutting rates further. This is mainly because growth has been a bit resilient and rates are closer to neutral in many countries. So central banks want to save bullets for the rainy day. So we now think that the easing cycle has come to an end in both South Korea and Australia compared to our previous forecast of further rate cuts.
Okay, brilliant. And in terms of the week ahead, is there anything we should be focusing on specifically in Asia?
Yeah, there are three main things to monitor next week. One is China's Tier 1 activity data, which we think will show a marked slowdown. So we're expecting IP growth to moderate to 5.5% in October from 6.5% in September. Retail sales, we think, will moderate to 2.1% from 3% because of the payback from the trade-in program. And the fixed asset investment growth, we think, will still be weak at minus 6.1%. This is slightly better than the minus 6.8% in September due to funding from the policy banks. But overall, we think the Tier 1 data are going to disappoint. The second is India's October CPI inflation. We're expecting that to moderate below 1% to 0.4% from 1.5%. So food deflation continues. We think core inflation will moderate. This is also the first month where potentially we see the impact of the lower GST rates, although most likely we think given the lags in transmission, it'll take a few more months for the GST cut impact to show up. And finally, we're watching the Australian employment data. So the monthly data tend to be volatile, but we are estimating that employment rose by around 15,000 in October, similar to last month, and expecting the unemployment rate to be steady at 4.5%. I think overall, when we look at the gross flows data, it does suggest to us subdued hiring, but also subdued firing.
Yeah, I think, the Aussie picture, we've kind of argued there's still some positives out there and the RBA is not going to be cutting anymore. So we do think there's a potential for the Aussie currency to outperform as well, something to watch, although it's being a little bit beaten up by the risk environment, which we've discussed earlier in the podcast, but we'll see where we go next week. Anyway, so thank you very much for joining us as always, and we hope to speak to you soon.
Thanks a lot, Dom.
Well, that does it for this week. Thanks to all our contributors. Thanks to John Dalton, who edits and produces the podcast. And thank you to all of the listeners for joining us again. We would love to hear your feedback, so please do leave a review or comment and let us know what you like, what you want to hear more of, and what we can do better. Please like and subscribe to Nomura's podcast on Apple, Spotify, SoundCloud, or wherever it is you get your podcasts, and share this far and wide with anyone you think would find it interesting. You can also check out NomuraConnects.com for more of our content. Thanks again, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.
Well, that's all for this week. Thanks again for listening to the Week Ahead podcast, edited and produced as always by John Dalton. You can like the show and subscribe on Apple, Spotify, SoundCloud, or wherever it is you get your usual podcasts. We'd really appreciate your feedback. So if you're happy to leave us a review and tell us what you like and what you want to hear more of, we'd love to read it. We'd also love to have this podcast reach far and wide, so please do share with anyone you think may be interested. As always, you can check out NomuraConnects.com for more of our research and updates. Thanks once again, and good luck for the week ahead.